Welcome back to the Wall Street Podcast. Today, we're taking a close look at Goldman Sachs' first take on NVIDIA Corp, NVDA. This was just published August 27, 2025.
That's right. The report digs into NVIDIA's Q2 25 results and their guidance for Q3. It's really about measuring performance against what were very high market expectations, identifying what investors are focused on now.
Okay, let's jump right into that Q2 performance summary. What were the headline numbers?
So NVIDIA reported revenue of $46.7 billion. Gross margin came in at 72.4%, and operating EPS was $1.04.
And how did that stack up against the street?
Generally, it was in line, maybe slightly ahead on some metrics. Data center revenue, though, $41.1 billion, was actually a touch below estimates.
Interesting.
But gaming, on the other hand, at $4.3 billion, came in stronger than expected.
All right, so a bit of a mixed bag relative to specific segment forecasts. What about the Q3 guidance?
For Q3, the midpoint revenue guidance is $54.0 billion. Non-GAAP gross margin expected around 73.5%.
Okay, and how does that guidance look?
It aligns pretty well with current street consensus, but it was actually below Goldman's own internal estimates.
Right.
And one very specific point they made, no shipments of the H20 product to China during the quarter. That's the chip designed to comply with export rules.
Okay, we should definitely circle back to that China point. So, beyond the numbers, what are the key areas Goldman flagged for investors? What should you be watching?
They really zeroed in on a few things. First, commentary around customer demand, is it holding up, and any supply chain issues.
Makes sense.
Then visibility into 2026 revenue.
Hmm.
Especially thinking about the next big product cycle, the Rubin launch.
Uh-huh.
Specifics on the China business, given those restrictions we just mentioned. And naturally, gross margin trends, can they sustain these high levels?
So the overall environment for AI spending still looks solid, according to the report?
Yes, definitely confirmed a strong AI spending backdrop. But because NVIDIA only met, rather than significantly beat, those really high expectations, the read-through for other chip companies like Broadcom, AMD, Marvell was considered, well, neutral.
And Goldman's position on NVIDIA itself?
They're maintaining their buy rating target price of $200. But they do note the risks, any slowdown in AI spending, rising competition, and potential supply constraints.
Let's dig into that phrase, inline performance amidst elevated expectations. It sounds a bit like faint praise for a leader like NVIDIA. What's the real meaning there?
Well, it signals that the market's anticipation was incredibly high. A lot of the good news, like the ramp-up of the Blackwell platform, was arguably already factored into estimates, both by Goldman and the broader street.
So meeting the bar wasn't enough to really impress.
Exactly. NVIDIA met a very, very high bar, which is impressive in itself.
Right.
But in this kind of hyper-growth sector, the market often wants, a jaw-dropping beat. So in line can feel a bit flat, potentially leading to some modest stock pullback just because there wasn't a new positive surprise.
Got it. Now back to that H20 point, no shipments to China. How big of a deal is that strategically?
Oh, it's quite significant. It really underscores the real-world impact of regulatory controls on a major market.
It's not just numbers, it's strategy.
Precisely. It affects NVIDIA's planning for that whole region. It highlights the need for diversifying revenue streams, especially when facing ongoing geopolitical and trade issues. It really forces a kind of strategic adjustment.
Okay, broadening the view now. What does this report suggest about the AI infrastructure sector as a whole?
It confirms the spending is still robust, the demand foundation is strong, but it also hints that the competitive landscape is heating up. And maybe more importantly, meeting these extremely high growth expectations consistently is getting tougher. It suggests the market might be starting to mature, shifting from that, explosive initial surge to perhaps a more normalized, though still strong, growth phase.
So the gold rush might be settling into, let's say, more established mining operations.
That's a good way to put it.
Yeah.
Still very valuable, but maybe less wild acceleration.
Finally, let's bring this home. How does all this NVIDIA's performance, market dynamics, competition impact the average person? Why should you care?
Well, NVIDIA is fundamental to so much AI development. Their performance impacts how quickly and cheaply AI tools can be built and deployed. So steady growth, like we're seeing now, means you'll likely see consistent improvements in things like your phone's AI features, cloud services, maybe smarter apps, but perhaps not those sudden, dramatic leaps forward every single quarter.
And the competition and supply nodes.
Those factors directly influence future product availability and pricing. Think about the cost and features of the next generation of AI-powered gadgets or services you might use, from consumer tech to things like medical diagnostics, or even entertainment. It shapes how accessible these innovations become.
It's fascinating how much pressure there is on these leading companies in fast-growing areas, constantly needing to exceed already huge expectations.
It really is, and it makes you think about how those relentless market expectations aren't just shaping stock prices, but actually influencing the pace, the investment, and maybe even the direction of innovation across the entire AI landscape.